So here are the adjustment of the accounts first and later on. So when prepaid expense occurred, you prepaid expense become our assets. So entry would be prepaid expense to cash. When we start consuming the prepaids, so entry would be expense to prepaid expenses. We're slowly charging or we're slowly decreasing our prepaid, so that's why we are crediting our prepaid expense later on, right? For unearned revenue is our liability. When unearned revenue occurred, so we create liability because we receive cash against the revenue. So at first entry would be cash to unearned revenue, and then we start adjusting unearned revenue. We have to make entry which is opposite to this one. This one is right now credited. Later on it will be debited against revenue because now we are claiming part of unearned revenue to revenue. So the entry would be unearned revenue to revenue. For accrued expenses, when expenses occurred but not paid, so we create expense to payable, right? When we pay, then entry would be payable to cash. Remember, when expense occurred and not paid, we create liability as expense to payable, and then when we start paying, then liability is decreased. We liability decrease between debit, and then we pay through cash. Cash decrease, asset decrease, credit. So that's why this is credit, right? And then accrued revenues, which means revenues you receive cash but you did not deliver the goods. So when this happens, so sorry, accrued revenue, which means revenue occurred but you did not receive the cash. So when revenue occurred, you create revenue increase credit, but cash is not received, so we create receivable customers, right? So account receivable to revenue, and when cash is received, so cash increase debit, receivable decrease credit. So summary of the adjusting process is that two purposes of the adjusting process are measure the income and update the balance sheet. So therefore, every adjusting entries affect both of the following: revenue or expenses to measure the income statement, asset or liabilities to update the balance sheet. Let's see that. The summary of the adjusting entries is just for your own understanding. The logic we already explained extensively in our previous slide. So categories are prepaid expenses. They are always debited against the and credited against the asset. Depreciation is our expense and it is credited contra account. And then accrued expenses, they are debited as expense and they are liabilities against liabilities, credited against liability. Accrued revenue, debited debited assets against our credit against revenue. Unearned revenue, which is debited to liability and credit against revenue. So like individual taxpayers, corporations are subject to income tax as well. They typically accrue income tax expense and the related income tax payable as the final adjusting entry of the period. To understand this one, we have an illustration here. So Credis Auto Services Corporation would make an additional adjustment entry to accrue income tax expense, the related income tax payable as the final adjustment for the period here. So it accrues income tax as follows. Accrued expense means expense incurred but not yet been paid. Entry would be income tax expense to income tax payable. right? We create liability that we have to pay but we didn't pay yet. So that's why we have create income tax expense to income tax payable. So income tax expense is a part of income statement item. Income tax payable is liability. Part of this is the part of balance sheet item. Okay. So exhibit 3.8 summarizes the adjustments of Friday's Auto Service Incorporation at the June 30. The adjusting entries we have already examined over the past few slides. So panel A repeats the data for each adjustment, while panel B gives the adjustment entries. We'll see the panel C on the coming page, in which the adjustment entries are done. So prepaid rent expired 1000, which means we consume prepaid rent 1000. Entry would be rent expense to rent prepaid rent, right? So rent expense to prepaid rent 1000. Supplies used 300. Supply used, which means consumed. So supply expense to supplies. Depreciation on equipment 400. So which is depreciation expense to accumulated depreciation, right? Accrued salary expense, salaries occurred but not been paid. So we create liability, which is salary expense to salaries payable. Accrued service revenue, which is 300, which means service revenue occurred but not yet been received. So we create account receivable. So account receivable to service revenue. Amount of unearned service revenue that has been earned 200, which means part of the unearned revenue 200 is earned. So we reduce the liability, unearned liability, we reduce it. So unearned liability, unearned service revenue to service revenue, because we recognize now the service revenue. The last part is accrue the income tax expense 600, means expense occur but not been paid. So not been paid, which means we create liability. The entry would be income tax expense to income tax payable.